Conditions for active investment management are favorable this year, with rising inflation, which is expected to remain high, even if the current supply bottlenecks see further easing. Rising inflation tends to reduce the diversification benefits of a portfolio. Add to this the fact that the year began with very high equity valuations worldwide. Apple, for example, reached a record stock market value of $3,000 billion for the first time. In comparison, this is 4 times more than the value of the Swiss GDP. Well, over the next 5 years, market returns are likely to be much lower than before. What if interest rates rise rather than fall? What happens if we have a more volatile environment in the future because central banks can no longer be as accommodative due to higher inflation? Rising inflation and the steady reduction in stimulus, which we call tapering, lead a potential turning point here. The old patterns have changed. If bonds and equities become positively correlated, bonds will no longer provide the same level of defensive characteristics as in the past. This means flexibility is the order of the day. The once popular buy and hold investment strategy may no longer be relevant, and investors need to adapt more quickly. Active investing has become more attractive, considering that volatility generally offers greater opportunities. We continue to favor funds that are uncorrelated with traditional asset classes. Furthermore, in the context of increased volatility, uncertain markets, and increased inherent risk, the sub-strategies we favor have at least one of the following characteristics: diversification, trading approach, focus on liquidity, relative value style, search for idiosyncratic opportunities, dispersion, and convexity.